Now, for more on the registration-based system, CCTV's Philip Yin interviewed David Dollar. He's a senior fellow with the Foreign Policy and Global Economy and Development programs at the Brookings Institution.
You know, most advanced economies have this registration system. So if you meet the standards, you can go into the market. Now, there's still an important role for regulators. Regulators have to make sure that the independent auditing companies are doing a good job. And you have to make sure that these companies going to the market actually have audited statements. So regulators are still important, but it is a system in which some of the companies that go into the market, you know, they may have had a few years of profits, but it's not really a solid basis. You get some failures. So in the United States, we often delist companies, meaning that they've basically failed and gone bankrupt. In China, China's never delisted a company as far as I know. So I think it is a looser system in some way.
I'm thinking from the perspective of companies. There's been a lot of talk of providing more loans and assistance to sort of SMEs and medium-sized companies. And I can imagine perhaps one of the reactions they might have to this announcement or this discussion is it might make it easier for them to access the capital markets to raise money, whereas before it might be a lot more cumbersome, as you said.
Absolutely. That's one of the important arguments for this reform. It'll make it easier for small companies to go into the capital markets. As it is now, the approval process is long and bureaucratic. Only a few firms get approved. So, you know, if you're a small manufacturing firm from Zhejiang or Guangdong, it's not likely you're going to get approved to go onto the Chinese stock market. Now, if you meet the standards, you can use the capital market to raise money. And then let me add, there's an important indirect effect. In the United States, companies overall get about 2/3 of their financing from capital markets, 1/3 from banks. And to be frank, a lot of the big firms rely exclusively on the capital markets. What that means is banks tend to focus more on small and medium enterprises. In China, firms get about 1/3 of their financing from the capital market, 2/3 from banks. So even if a lot of the beneficiaries are big companies, the banks then are going to start looking around for new clients, and they're going to be more interested in small and medium enterprises in China.
It wasn't that long ago, David, that we saw record number of IPOs from China on the New York Stock Exchange and also on the NASDAQ. And things have changed quite a bit. And I wonder if part of this perhaps will take away some of the companies that may have listed perhaps in New York, but rather now they're looking at perhaps listing back home in Shanghai or anywhere else in China where they'll have easier access to capital. What's the impact to our friends in New York?
You're absolutely right. You know, some of those Chinese companies went to New York and Hong Kong because the domestic stock markets in China were, you know, very bureaucratic. It was difficult for private firms to list. So you have a private firm like Alibaba listing in New York. I think you're right that these reforms are partly stimulated by those developments, and they will bring more firms coming onto the Chinese markets, not going overseas. That's basically good for the Chinese economy, and it's good for Chinese households and investors. I don't think it's too much of a problem for New York or Hong Kong. They get lots of firms from all over the world. So I think this is basically a healthy reform for China.
Impact on investors, the ones in China and the ones outside of China that want to be in China, I guess.
I think for the investors in China, it's basically positive. It means there'll be more companies coming into the market. You know, Chinese households have a lot of savings. They've lost confidence in the real estate market. So the stock market would be a natural place to put money. But the stock market in China is pretty thin. So I think this is basically good. I worry a little bit that some households may assume that this naturally leads to rising stock prices. It's impossible to predict stock prices. They're just as likely to go down as to go up. So there will be ups and downs in the market. So I hope households realize, you know, that stocks are always a risky investment compared to, say, putting your money in the bank at a low rate of interest. That's nice and safe. But basically, this should lead to a healthier development of opportunities for Chinese households